Good morning and welcome to Charting the Markets on Friday, the 8th of December 2023. The main mover overnight was the Nikkei 225, which continued to slide and dumped by 1.7% as the Japanese yen actually appreciated whilst we saw lower GDP data for the third quarter in Japan. Yesterday, the Bank of Japan Governor Kazuo Ueda announced or hinted at a possible restrictive monetary policy next year, and that led to a complete repricing with regards to the yen, which strengthened on that news. And basically, we saw the repercussions on that on dollar yen, and we'll look at that in detail later on. But let's first of all focus on today's data. At 1:30 p.m. we've got the highly anticipated non-farm payrolls out of the US, and we expect payrolls to come in at around 184,000 versus the previous reading of 150,000. We have also average hourly earnings, which are expected to rise by 0.3% compared to a previous reading of 0.2%. And the unemployment rate is expected to stay unchanged at 3.9%. But the risk here really is that we could perhaps see unemployment rise to 4%, which could then lead to a minor sell-off in equity markets, because after all, they have been rising very steadily and strongly since the end of October of this year. So we'll have to look at what the data will be like with regards to non-farm payrolls, because earlier in the week we had the JOLTS data, and these are basically the job openings in the US, which came in lower than expected. And we also had yesterday the ADP data, the private jobs data, which also came in lower than expected. But usually these two are not really that good an indicator with regards to what we expect to see with regards to non-farm payrolls. So all eyes riveted on non-farm payrolls at 1:30 today, and then later on at 3 p.m. we've got the US Michigan Consumer Sentiment Index, which may also bring a little bit of volatility in. But the main event is the non-farm payrolls. But before we look at that, let's have a look at the FTSE 100, and you can see here that we have finally managed to break above our previous highs that we saw back in November and early December between 7,535 and 43, and are now trading at levels last seen in mid of October of this year, and are heading towards the 200-day simple moving average here in red at 7,567. Now, I've been targeting that for the last week or so, and we tried to break through that resistance area on Wednesday, didn't succeed in doing so, but this time around it looks as if we are on track for this 200-day simple moving average. And if we could extend that rally, depending on the non-farm payrolls data later on today, and probably also on what the central banks will be saying next week, because we've got the Fed, the European Central Bank, and also the Bank of England announcing their rates for the month of December. So we'll have to see whether we can see further upside momentum take us to the September to December downtrend line, which currently can be seen around 7,604. If you look at the German DAX 40 contract, you can see here that it's greatly outperformed the FTSE 100, which is still treading water and might just be approaching basically a neutral area with regards to year-to-date performance, whereas the DAX 40 is probably up around 14%, having risen by that much from its October low. And it's currently on track to retest its new all-time record high, which was made on Wednesday, here on this daily financial bet at 16,729. And if overcome, we could then be gradually heading towards the psychological 17,000 area. So much further upside still in store for the DAX 40 contract. Basically, as long as we stay above yesterday's low here at 16,594, for me, the uptrend is very much intact and still pointing higher. And if we look at US markets, we have seen these, for example, the S&P 500, stall marginally below their July high at 4,607 on this daily financial bet. Last week, we managed to rise to 4,599 before consolidating, as you can see here, in a low volatility sideways trading range. But now it looks as if we are banging on the upper boundary of that sideways consolidation phase, and if we were to rise above 4,599, it's pretty likely that we would also overcome the July high at 4,607, and that would then open the way up for us, if I go into a weekly chart here, to reach the high seen back in March of 2022 at 4,637. That's our next upside target for the S&P 500. Depending on what obviously the data will be later on today with regards to non-farm payrolls, whether we can break through that resistance area or not. But if we can, that will be the upside target that we are aiming for. Now, technically speaking, the upside is still, despite the sideways trading pattern we are trading in at the moment, very much intact as long as we stay below the above the late November low at 4,537. So that's the line in the sand here for the bulls with regards to the S&P 500. The US dollar has regained recently lost ground over the course of this week, and if we look at euro dollar, we can see the inverse of this, and you can see here on the daily financial bed that we had basically 6 consecutive days of losses take us down to yesterday's low, which was made at 107.55. And as you can see here, I've drawn in a support area made up of the mid-September and also the early November highs between 107.69 and 56, which has basically held the currency pair short term. But interestingly enough, we're now trading below the red line here, below the 200-day simply moving average at 108.24, and are trading in a very low volatility range ahead of today's non-farm payrolls data. So we'll have to see whether a softer reading of the US labor market may actually lead to a slightly weaker dollar, in which case we could have a bounce back to above the 200-day simply moving average, take the euro-dollar exchange rate back towards the 109 area. But if the data comes in line with expectations, it is possible that this recent steep downtrend may actually continue next week and then take us down towards the late October high at 106.95 and perhaps even towards the mid-October high at 106.39. So the jury is out on that one. Short term, we're holding here at support. The level to watch out for today is yesterday's low at 107.55. Failure there could take us down, as I said, to 106.95 and also the 55-day simply moving average at 106.92. But on the flip side, if we were to manage to rise above yesterday's high at 108.17 and also the 200-day simply moving average at 108.24, we may be heading back up again towards the 109 area. So watch that breakout later on today, which may well happen because it might give us a good indication of where we're going to head next. Now, the euro had been falling over the last few weeks since we saw a weaker European inflation data. And as expectations of a ECB rate cut were brought forward by market participants, the euro basically depreciated against a lot of currencies. And you can see the depreciation against the Japanese yen. Now, the Japanese yen is also very interesting because yesterday, as I just mentioned beforehand, the Bank of Governor Kazuo Ueda basically hinted at the possibility of the central bank moving away from its ultra-restrictive monetary policy next year, which was earlier than expected, and that led to the Japanese yen rising quite significantly. And you can see the opposite of that happening here with this very long, basically bearish candle taking us down to 153 yen and 18 sen yesterday, and that was a low which we hadn't seen since the end of July of this year. But interestingly enough, euro yen then found support not just yesterday, but also today, around the 200-day simply moving average here in red at 153.98. And we are now currently bouncing back up again and could reach the 156 yen area. And then above there, we've got some pretty good resistance going back to the late August and September lows between basically 156.58 and 156.87. So that's a possible resistance area going forward today with regards to euro yen. Now, dollar yen is also interesting because what we saw there is, again, the same acceleration to the downside. So on that stronger Japanese yen, taking dollar yen lower here to the 200-day simply moving average yesterday. And today, again, we held around it. and are currently bouncing back and trying to retest the late August and September lows, going up to 144.45. But basically, the fact is that we will most likely see the Bank of Japan remove some of its massive stimulus going forward, and will probably see the central bank in Japan tighten its monetary policy when other central banks, such as the Fed or the European Central Bank and even the Bank of England, are looking to actually start cutting their rates. So that will be very interesting with regards to the currency for next year. Now, today we had this weaker than expected third quarter GDP data out of Japan, and that plus a current account surplus which exceeded forecast and remained positive for a ninth consecutive month has led to a minor recovery here in the currency pair, as you can see. But we'll have to see whether we can rise all the way back up again towards Wednesday's high at 147.50, because only a rise above there would mean that we have actually bottomed out here. So unless that happens, and I don't think that really looks very likely at the moment, the odds are still pointing towards further downside. And if we were to fall through the 141 yen and 63 sen low made this week, then we could actually envision retesting the 138.08 low from July of this year. The slightly stronger US dollar has had a negative impact on the gold price, but before I talk about that, I'd like to mention the price of crude oil. And if we look at the daily financial bet of WTI, we can see here that, let me just get the right chart up. Sorry, here we are. We can see that we've had 5 consecutive days of falling prices with regards to the oil price, as OPEC Plus members seem to squabble about the potential future output cuts they are discussing and can't really agree on. And we had a minor bounce back earlier today and also a little bit yesterday, as Russia and Saudi Arabia basically tried to get the other OPEC Plus members to agree to the output cuts. And so far, we've slid to $68.99. Here's the futures contract, that's just $68.99. We're seeing a minor bounce, but basically, as long as this resistance area now made up of the early and mid-November lows between $72.38 and $74.97 caps, further downside looks to be in store for the crude oil price. And that could then take us back down again towards the June and July lows, which were made between $67.13 and $67.12. So that is definitely still on the cards. As you can see here, we have a very clearly defined downtrend, lower lows, lower highs, and we're just seeing a minor bounce in a downtrend on this chart. Now, I mentioned the gold price, and you can see here that we hit a new all-time record high on Monday. We actually gapped higher, and that was on the back of the Israel-Hamas war resuming, and that basically was then very much quickly followed by not just the closure of that gap, by this basic bearish engulfing pattern. And that indicates, when you see a bearish engulfing pattern, that further downside is most likely in store. And that we did see, to some degree, take us down to $2,010, just above the mid-October or the late October high, $2,009 per troy ounce, which acted as support, together with the October to December uptrend line. As you can see here, we've been trading above it in a very low volatility trading range ahead of today's non-farm payrolls data, where we could potentially see a move out of the sideways trading range occur. Now, if it were to occur to the upside, we would have to take out Tuesday's high at $2,041. If that were to be taken out, then we could be heading back up again towards the $2,070 to $2,083 area, which were the highs going back to 2020, 21, and 22 and 23. But if we were to slide through this uptrend line and also fall through the December low and the October high at $2,009, then it's likely that we retest the psychological $2,000 mark. But right now, not much is going on. We're just awaiting further data with regards to unemployment in the US later on today. And last but not least, I'd like to mention US natural gas. And you can see here natural gas prices have been in a very steady downward trend since the end of October of this year. And so far, they've taken us down to basically a level last seen in August of this year to $2.47. Below there, we've got this, because that's below this previous support area going back to July and August. But below there, we've got the June low, which comes in at $2.16. That's a possible downside target. And ahead of there, you've got this uptrend, the support line here going back to April of this year, which comes in around $2.39. So that would be the next downside target, $2.39 ahead of the sort of $2.16 area, taking us back to the June low of this year. Now, resistance is seen along the 200-day simply moving average here in red at $2.71. And as long as we stay below the last reaction high, that's to say a high which is higher on the daily candlestick than the one to its left and to its right, that is to say Tuesday's high at $2.77. As long as we stay below there, the downtrend is very much intact and further downside is likely to be seen. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.